Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we have quite a few different charts that we want to show you and some of the economic numbers that we're currently looking at to inform our decisions here for trading. So let's go ahead and get started here. But before I do, a quick disclaimer, what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's go ahead and start off by talking about where the broader market is currently trading. The S&P 500, we have been talking about this for quite a few weeks now, has been contending with this 300, 302 level. Prior to that, the market has really been stuck between this zone between 275 or so and 290 or so, 295, and has really struggled to get above 295. But over the last couple of weeks, the market has really been able to get above those levels and have been able to break out higher. Now, last week we started to test the 302 level. If we're looking at the daily chart here, as you can see, the daily chart really has provided some moves to the upside. Let me see if I can get my pointer here to work. There we go. It has broken out to above that 295 level and now tested 300 or so, 300, 302, which is a major resistance level. And over the last couple of days, the market has been able to break out above that 302 level, which is significant because it puts us in a significantly more bullish state here for the markets. Really a bit of a disconnect from where we're seeing everything else, and I want to look at some of those numbers as well. But I want to take a look at this rally in the context of other sectors and markets as well, because not only is the broader market rallying, if we look at the technology index, this is the QQQ, which tracks the NASDAQ 100 index, we are now basically at its all-time high. We are within just a few points from its all-time high. I suspect that between the next couple of trading days, we're going to test, potentially get rejected quickly, at first, and then potentially bounce higher above that. Now, we do want to take a look at all of these metrics because I've been getting a lot of questions over the last couple of weeks regarding, is the markets overbought or do we see signs of exhaustion? And certainly, I think on some metrics, you would certainly say that valuations are stretched, but I wouldn't quite call it overbought because if you look at RSI, it's been a pretty steady climb here. It's still in the high 60s, so not quite overbought. Overbought is well into the high 70s, low 80s that we saw back here in January and February when things got a little bit overbought. As you can see right now, we are nowhere near those overbought levels. So I think that there's still significant potential momentum for this market to move higher despite everything that we know that's currently going on. So I do want to point us to taking a look at some of the equal weight indices as well, because as crazy as the market seems, the equal weight index right now is still rallying, which supports this significant move to the upside. So when we look at the equal weight index, recently it broke out above, this is the S&P 500 equal weight index. It recently broke out above a major $98, $99 resistance level, came back to retest it as support and is now starting to move higher. So this is all supportive of this broader move higher that we have seen in the S&P 500, in the NASDAQ 100 index, and the Dow Jones index. So when you see equal weight, when you see the value S&P value index all move higher, this is all supportive of this market continuing to move higher. The Russell 2000 index, the small cap index, same thing. This is one of the things that was covered on CNBC this past week. Carter and Mike was actually looking for a bit of a pullback here, but I took a bit of a contrarian view. I said the fact that we broke out above this 135 triple top is bullish. We had that small move to the upside, pull back to support, and I think that you're going to get a rally higher here in small caps, at least into that 145, 150 area, which has been a solid level of resistance here going back to February or so. So I do think that at least small caps are going to get a small boost here, which is again supportive of a broader rally. Now, I do want to point out that throughout these rallies that we've had over the past few weeks, one of the things that is important to note is that the VIX has not moved any lower. The VIX has been basing here just above 26 or so. It hasn't moved any lower as you would normally expect for the markets to open up. Now, with the markets opening up around 307 today, another 2 points higher, we might see VIX tick a little lower here, but it's important to note that volatility has not quite come down in the last few weeks, despite markets moving higher. This does mean that there are some opportunities in terms of selling options. So we have some trades or trade ideas that we're going to look at that involve selling options instead of buying options. But as volatility bases slows down and is staying around this $30 level, we do want to start taking a look at buying some options, especially when markets reach this type of not quite euphoric state, but certainly stretch valuations where many times if you're looking at stocks and you say, well, markets are clearly going higher, I want to be participating in these moves higher, but I really have I'm really uncomfortable with buying stocks at these types of valuations and continue going long because I know that there's a significant pullback risk. That's really where we want to turn to options. We want to buy options so that we can gain that that bullish exposure, but do so in a way with limited risk. So, the question that we've been getting over the past few weeks is really, with all this disconnect that we're seeing in the markets, what is going to spark markets reconnecting with where real economic numbers look at. And that's really kind of, a bit of a black swan that has come out of left field over the last week or so, is these protests that we've seen across the nation, and violent protests that have resulted in curfews, that have resulted in businesses continuing to shut down despite economies trying to reopen back up. Is this the black swan that causes a second wave of COVID-19? Is this the black swan that causes more businesses to fail, that we're on the brink of failure, that was just starting to come back to life? It's hard to say, but this is certainly something that we are monitoring. At the moment, the market is not reacting to it, despite the fact that things seemingly are getting worse across the nation over the past few days. Markets are still continuing to march higher, shrugging this off at the moment. Similar perhaps to how we shrugged off COVID-19 at first, until things got a little bit more serious. So this is certainly one of the things that we are paying attention to. So overall, broader rally, which is good and supportive of a market rally, because when you have a narrow rally, meaning just a few stocks that are bringing the markets higher, that's when you have instability. That's when you have the potential of a nasty sell-off or a bear market sell-off. But we're not quite seeing that. We're seeing the broader market rally, which is good. VIX is basing, meaning stabilization in VIX. Oil has also had its largest monthly gain, so oil is stabilizing. We are currently seeing signs of exhaustion of this rally, but again, not nearly overbought. We've been getting a lot of questions saying, things are really overbought. Why are you not shorting the markets? And the answer is that things are not overbought yet. We do certainly see signs of exhaustion, but there's no catalyst and there's no signs of this market being overbought just yet. But we are very cautious. And again, that's why we're turning to options to utilize call options, call spreads to take advantage of the bullish opportunities to the upside, but do so in a way with limited risk. And there are some, I would say, select potential bearish opportunities to take in this market, especially due to COVID-19, due to the protest, that may present itself here over the next few weeks. Liquidity evaporated a bit last week, but has improved quite a bit again, 254 very liquid optionable symbols. And I do want to, take a look at some of the economic numbers, because I want to remind viewers here that despite that the markets are moving significantly higher and we're seeing this broader market rally, I want everyone to understand what numbers we're seeing, the underlying numbers, because they are quite poor, and it's important to know this and understand where we actually sit from an economics perspective. Because if you just look at the S&P 500, you would think that we're past COVID-19, that everything's getting back to normal, and the reality is that we're nowhere near there. So then we're going to take a look at that and some of the trade ideas. So first and foremost, I want to point us to some of the COVID-19 trends, which is something that we haven't really looked at in a while, because the assumption at this point is that we're past the hump. We're on our way back to normal. So let's ignore that and let's look at, you know, some of the optimistic side of things. But the reality is that the United States is actually pretty far behind in terms of our recovery rates towards, you know, compared to other countries. So as you can see, the blue line here is Italy's road to recovery, and they are very close to getting back to zero in terms of zero COVID-19 trends. The United States is still months away. You know, when we talk about, you know, when are you comfortable to get back out into restaurants and travel again? You know, this is stretching out to easily being the end of this year, early next year for that to happen at the rate that we're currently going at. And this is concerning for, you know, stocks that are currently, I would say, priced to perfection, priced to things getting back to normal in the next month or two. And the reality is that we're nowhere near that. If we look at retail sales, same thing. Notice the significant declines in most of the categories in terms of retail sales. The only one was grocery that initially had that bump, but is now coming back to normal as a result of people no longer stocking up and realizing that they're not going to run out of food per se, and we've seen a small decline in grocery. Online obviously has picked up, but it does not account or make up for the lack of sales in the other parts of our economy. And if you think about US GDP, 70% of it is consumer spending. This is really going to hurt us in the next few months. Chances are we're not really going to see some of this data until Q3, Q4, when things are when the recovery is not as quick as some of us may want, or some of the economic numbers are suggesting that it might be. So it's important for us to also understand what economic numbers to take a look at. So manufacturing PMI. This data set looks very similar to most of the economic data sets that we've seen, where you've had a significant plunge, and we've recently started to see this small uptick. Now, many times I would say the small uptick is really what's caused a lot of this broader market rally, seeing that things are no longer getting worse, things are starting to get better, and I think people are, and the markets are being optimistic as far as the worst is over and things are going to get better. Now, the question is just the velocity at which things are going to get better. Is it going to look like a V-shaped recovery? Is it going to look like this and then it starts to get worse, or just move sideways for significantly longer before it gets higher? This is really where I think the potential stumble that we may have in this rally. But these types of economic numbers come out, you know, they're lagging. Sometimes they're weeks behind, if not months behind. Capital expenditure, same thing. We've seen significant plunges in capital expenditure even before the dot-com bubble. Haven't seen levels this bad except for the financial crisis. Yes, most of these numbers have started to see a small uptick, and again, that's the optimism the markets are pricing in. But the question is whether or not this short-term optimism is going to last, or it's just going to start to decline and move sideways, or you're going to get that V-shaped recovery. So all the questions that you've seen on the internet about V-shaped recovery, U-shaped recovery, L-shaped recovery is really referring to the shape of these types of economic numbers, meaning does it look something like this? This would be what I would consider an L-shaped recovery. A U-shaped recovery would be something more like this. And more, or even W, you know, we've talked about W-shaped recoveries where it gets better and then it gets worse again and then starts to get better. So this type of data is going to take months, potentially years, for us to really understand the impact of all of this. And that's the difficult part about navigating the markets right now, is that the markets are basically very optimistic on the fact that we had this small V, but that V could very turn into a U or a W or some other shape at this point. And that's really, I think, what's going to dictate how the markets react to some of these numbers. So I really think it's important for us to realize that the markets are disconnected from these type of economic numbers at the moment, but I believe that they will reconnect once we have further data from some of these economic numbers. So with that, let's take a look at some of the trade ideas that we're currently looking at. First and foremost, I want to point us to Starbucks. Starbucks has been in the news recently. I think it was yesterday where they announced they were going to lay off, I think, or not lay off, but let go of 25% of their staff because of reduced demand that they're expecting. I expect that's going to provide some short-term boost because that's going to reduce the expenses that they need in terms of in order to operate. But if you look at the stock itself, it's been fairly weak from the perspective of it's trading sideways. It is in a sector that has been doing quite well, consumer discretionary sector, predominantly because that sector is being dragged up by Amazon and Home Depot. That makes up about 40% of XLY. But really the question is, as we continue to work from home for quite an extended amount of time, as protests happen around the country, as 35, 40 million unemployed, as we have 35 to 40 million unemployed people in this country, are we still going to go out and buy $5 lattes at the same pace we were back in January, which is where the markets are currently pricing a stock like Starbucks? And my hunch is that no. My hunch is that that's not going to happen. We have this major resistance level here at 80. And you could say to yourself, markets are, kind of moving slightly higher here. But if you compare it to the overall market, if you compare it to the consumer discretionary sector, this is a stock that's currently lagging behind and has the potential of a potential pullback here. There's a few ways to play this. You can sell a call credit spread to defend the $80 level and believe that Starbucks will not go above 80, or you can go and buy a put spread and bet that Starbucks is going to decline back into that $71, $70 level. Those are two different ways that I see that you can potentially play Starbucks here in the next couple of months as we approach the next earnings cycle and people realize that people are simply not spending money on these types of products at the same clip we were prior to COVID-19. Fast food, McDonald's. This is actually one of the I would say somewhat highlights of the consumer discretionary sector, especially when we look at restaurant credit card spend. There's a clear bifurcation between what we consider fast food like McDonald's and fine dining, which is predominantly restaurants, higher end restaurants. A clear bifurcation here because fast food, actually spending across fast food restaurants has pretty much been stable compared to pre-COVID-19 levels. Obviously, people have to eat, and with the choice and with COVID-19, people are spending more of their money on fast food rather than fine dining. And obviously that doesn't come as a surprise to anyone, but we have this major 190 level here, and I think McDonald's could be primed for a potential breakout here. Now, this is a bit of a speculative trade here, which is why, at least for me, for me to place this trade, and I actually have a position here in McDonald's, is to utilize options. That's the only way to play this, utilizing something like a call spread here to take a move like McDonald's here. So I would utilize something like a call vertical here where I buy a 185, 200 call spread. Here, as you can see, that call spread costs about $6.50 on a $187 stock. So if you think about that, that's only risking about 3.5% of the underlying stock price to take a bullish view on McDonald's until July expiration. You could also go out to August, which I actually think is probably the better timeline to utilize here, buying the 185-200 call spread, or you can use the 190-210 call spread, which again costs about $6.89, which is again roughly about 3.5% of the underlying stock price. And if McDonald's does break out above that 190 level, you are looking at, if the stock reaches, let's say, 210, which is well, into the prior, if the stock reaches 210, which is back towards its January and February highs, you're looking at about almost a 200% return on the $689 investment, again, which is 3.5% risk of the underlying stock, looking at about a 7% return on the underlying stock itself from this particular trade. So, these are the types of trade setups that I'm looking for in the markets. And more importantly, the way that I'm playing them is utilizing options and making sure that I'm risking a small percentage of the underlying stock price to take these types of opportunities. And this August expiration accounts for the next earnings cycle. So you're able to capture the next earnings cycle for only 3.5% of the underlying stock price. Those are the types of numbers that I'm looking for when I'm looking for opportunities going into the next earnings cycle. This is one of the trades that we highlighted here for options play today, which is Cisco Systems. And this is really coming down to some of the significant increase in network traffic we've seen since pre-COVID-19 and what we anticipate will likely stay as a result of people working from home, but also the security needs that companies have as they now distribute their workforce instead of in a centralized location across the entire nation or across the entire world. Network security and network traffic and handling that network traffic is going to be a big driving of revenue for stocks like Cisco Systems, which has done a good job over the last few years of diversifying their business away from just purely hardware into applications, into security. They've acquired a few companies in this particular space over the last few years, and I think they're positioned relatively well. And I think the price chart reflects that recent optimism, as you can see. And what I quite liked about Cisco Systems is that yesterday it declined about 3.5%, which is the type of opportunity or weakness that you typically want to sell into. And going back to quite a bit, you have this pretty solid, I would say, $46 support level going back to August of 2019. The markets broke down below this level during the COVID-19 sell-off. It just broke back above that. So I think this is your opportunity to potentially play for the long side because you have this breakout back above 46. It came back to retest this as support, and this is the potential push that you need higher. The minimum target here that I'm seeking here would be the $50 level here. So again, utilizing options, what I'm doing here for Cisco Systems is using a strategy of the same call spread that I showed you here before. As you can see, a July 46 $50 call vertical costs $1.47. $1.47 out of a $46 stock is, again, only 3.1% of the underlying stock price. So I'm only risking 3.1% of the stock price. And if Cisco System reaches $50, I'm looking at about 172% return on my call vertical here. These are the types of risk to reward ratios that we are seeking from an options perspective. These are the types of fundamental thesis that we're looking at during COVID-19, and especially if you're concerned about pulling the trigger on some of these technology stocks that are trading at some pretty stretched valuations right now. You need to have a fundamental thesis along with the charts, and more importantly, have an options trade that protects you so that if you have a major sell-off, if you have a second wave of COVID-19, you're protected against having a significant loss in your portfolio, because in a trade like this, we're only risking 3% of the underlying stock price to take a trade here like this. And lastly, General Motors. I wanted to take a look at General Motors because this is actually one of the highlights that I think we see in terms of consumer spending at the moment. Perhaps a bit of pent-up demand that was held off because of COVID-19. People who wanted to buy new cars did not go out to buy new cars. We've seen a significant increase. We've actually seen car purchases get back to pre-COVID-19 levels. So General Motors has struggled quite a bit over the past few months. But as you can see, it traded within this fairly big triangle for the last couple of months, but finally broke out above that $24, $25 level, had that initial breakout, came back to retest as support, and I think this could be your opportunity to look for a long position here for GM. Now, General Motors being up 4%, same thing, same type of call spread here that I would be looking at. You are risking a little bit more here. I do think that perhaps for this type of option, you might want to go a little further out in time. Unfortunately, General Motors at the moment does not list August options. You can either choose July, which in my opinion is a little short because you're missing that next expiration cycle, which is July 29th. If you go out all the way out to September, I do think that the trades there are certainly a little bit more expensive. $2.82 on a $26 stock means you're risking more than 10% of the underlying stock price. So this is certainly a little bit more speculative, but with if car sales do return back to normal, I do think that this is one where you have a potential better risk reward. This is a higher beta stock. It does move more. If you look at Tesla just broke out to brand new highs. So also reflecting the same type of optimism. GM, I think, is just a cheaper stock to play for the same type of leverage play on a resumption to normal in terms of car purchases. So a lot of potential opportunities here in the market. Again, I think that there are opportunities to the upside, there are opportunities to the downside. Most important of all is the fact that regardless of which directional view or outlook you may have on the market, the important part is to utilize options to limit your risk, because things can change on a dime, as we are currently seeing in the markets right now. Things are very stable at the moment. We're taking a very cautiously bullish, optimistic tone in the markets right now, but there are some destabilizing trends that could pick up very quickly, and we want to make sure that we're positioned for that correctly. So it's important that you utilize strategies like call verticals and strategies with limited risk to make sure that you are limiting your potential losses in your portfolio if things turn south. And having opportunities spread both long and short allows you to potentially take advantage of both sides if the market moves higher or if it moves lower, and spread your risk around. That's the way that I'm currently playing in the markets, and I hope that this was useful in helping you set up your Tuesday morning trading session. So with that, I want to thank everyone for taking the time out here this morning. I hope that you guys find this useful, and the recording will be sent out to everyone here as soon as we make that available. Thank you so much, and I hope you guys have a great day.